Get ready for more valuable financial insights from Northern California's premier retirement income planners, Dan Ahmad and Jim Files, owners of Peak Financial Freedom Group. For more information, go to peakfin.com. And now, here's Dan and Jim.
Welcome to the Peak Financial Freedom Hour, and this is Dan Ahmad and Jim Files, and we are here to give you some tremendous information, education on what you need to do to make the best decisions with your money, especially now that you're in retirement or you're within a year from retirement. Today, it actually is going to be titled, It's Time to Prepare for Retirement, and why all planning will make the difference. If you don't plan, it's going to make a huge negative difference. We'd like to welcome you all to the show. And Jim and I, we are the founders of Peak Financial. We work with retirees and soon-to-be retirees to help them create actual plans. We want to say hello to all of our local listeners that come on every week and hear the good news and the new news. And make sure that if you have listened for a while and you're saying, hey, I need some help, call in and schedule your 100% complimentary consultation with us today. All you have to do is dial pound 250 on your cell phone and say the keyword money, pound 250 and say the keyword money. And if you have questions, feel free, and we can probably answer some of those questions for you that'll relieve some of the stress. You can listen to our podcast, which is this radio show. It'll be played on our website as well as some of the podcast stations. We have a great YouTube channel that has tons of video explanations, education that you can really put yourself in a position, we think, to make really good decisions. So feel free to go to the Peak Financial YouTube and don't hesitate ever to contact us, because basically, you have to think about it right now. If you're tired of worrying about your future, and even if you say you don't worry about your future and money, we know you do. Every single person does. So if you're tired of that and you're ready to then get some answers and work with someone who will sit down with you on the same side of the table and listen to what you're saying, just give us a call or just go to our website and see what we're about. You can download our most recent best-selling book, Mama's Secret Recipe for Retirement Success. It was co-written with Jack Canfield. He's the guy who wrote Chicken Soup for the Soul. His book sold over 500 million copies, and we were lucky enough to get him to write the foreword endorsing our book. So just make sure you give us a call, pound 250, and say the keyword money. Hey, Jim, why don't you start the show off with quotes of the week and give us a few of things that are important so we can understand the philosophy about making good financial decisions.
And I'm going to give you one great quote. It was from Thomas Edison, and it really matches, Dan, what you and I do here for people that come to see us about their concerns about money and about concerns about retirement. And Thomas Edison said, good fortune is what happens when opportunity meets with planning. And that's really what our entire firm's about, Dan, is planning. How do we plan constructively and prudently to make sure that our clients have the highest probability of success in retirement? And the planning element, people don't really understand because they're used to having their money invested either by themselves or by a broker or by an advisor. They don't have a plan in place, although they may think they have a plan in place because that's their statements. I think the plan is having 60% stocks and 40% bonds in their portfolio. But that's not a plan. That's an investment strategy, but not a plan. So, I thought that was a great quote that Edison delivered many decades ago, and it still applies today with what we do in our practice.
Well, just his whole quote, you can dissect it, and he's saying good fortune. Well, a lot of people think that means luck. Well, good fortune is what happens when opportunity meets planning. Luck is when you get a good result and you haven't planned. So good fortune comes from the planning, because you can create your own good fortune. The only way to create your own luck is to make sure you're planning properly, to make sure that you've planned against the bad luck scenario. So yeah, I think, Jim, you're exactly right. That's exactly what we do. And it ties in then to the exact topic of this show, which it's time to prepare for retirement. And I think one of the key things is we have to talk about the two stages, because so many people right now listening, they're retired or getting ready to retire in the next year-ish, and they think they literally are prepared for retirement simply because they've saved money and they've accumulated a decent amount of money, $1 million, $2 million, $3 million, $5 million of assets they've accumulated. So they think they've done their job. Well, they did do an awesome job and they've been successful in accumulating assets. But if you look at the second stage of retirement planning, which is asset preservation, and then using those assets to create income that's dependable, that will last for as long as they live, that will replace their paychecks, I would tell you right now, 99% of the people listening right now have not succeeded in that area because they have no idea, no clue. How do they use their assets to create income that's going to provide their lifestyle right now, Jim?
Well, it's because they've never been taught that theory or that philosophy. All they've been taught is, hey, I'm going to invest my money in my 401k while I'm working. I'm going to dollar cost average in, and I'm going to wake up in 40 years when I retire and I have enough money there to retire on. What they haven't done is any type of planning to say, okay, I've built this huge nest egg of money that has to replace my paycheck in retirement. How do I structurally put these assets in a position so I don't lose a lot of them, right? And that's a big concern right now, because if you look at the S&P 500 today, it's about 5,700. If you look at the historical trading on the markets and earnings per share and all that technical data, it's trading at 22 times next year's earnings, which means that in a normal market, historically speaking, it should be trading at about 15 times. So in theory, we're 25% more aggressive or a higher valuation with the stock market than it should be in historical times. So
almost actual 50%.
Yeah.
From 15 to 22, that's almost 50%.
Yeah, it's huge.
Yeah.
So that means that if the market dropped 50%, it would in theory be in a normal range of where it should be. But the consumer doesn't even think about this. They listen to CNBC, they look on the internet, the market's going up, and they are significantly more aggressive, Dan, than they should be at this point.
I think they actually think about it. I think they actually worry about it, but they're told all the other things that they've been told as they've accumulated assets. Hang in there, ride it out. It'll be okay. The market will always recover. You'll get 12% rates of return, etc. And those are fine statements if you're 20, 30, 40, even 50. But once you get close to retirement, within 5 years of retirement and in retirement, you no longer can use those old adages. You have to switch from an aggressive mode into an asset preservation mode and an income distribution mode. And every single person listening knows that right now. They think that, they believe it, and they want that to happen. They just have no clue how to do it. And if you have no clue how to do it, and that's what you want, it starts freaking you out. You have anxiety, you worry, you can't sleep. And a lot of people don't talk about it, but we know 100% the majority of people listening right now, they're worrying about the money. So that's why we're saying it's time to prepare for retirement, not just saving. You've already accomplished goal one. And most people, because they don't have a plan, they don't even realize they've succeeded and they're freaked out now. Clients came in last week, they have $3 million of assets and they're 62 and they want to retire. And they're so afraid they don't have enough money saved. They're going to have to work till 70 because their whole idea now is we have to get to $5 million of assets, which, okay, that's a good goal. Yep. But do we need $5 million of assets to produce their lifestyle? And it came true after planning. They can retire right now and they'll have $5,000 more per month to spend than they need. So have they succeeded at this point?
100%.
100%. They've crossed the finish line.
Yeah. But what they should have been concerned about is if I have $3 million of assets saved and I want to go to 5, and you realize where the valuation is with the stock market, and the market could drop 20, 30, 40, or 50%, they should be concerned about how do I protect my asset base? And now they are, right now that they've been educated on that. And people say, well, Jim, I don't think the market can drop by 50%. Well, I'll say that's nonsense, right? Over the last 24 years, we've had 50% drops, more than 50% drops. That was the 2001 and 2 tech bubble. Market went down 53%. So if you had $1 million, you dropped to 470,000 if you had the money in the S&P 500. And then in 2007, 8, and 9, the market dropped 57.4%. So if you had $1 million, you're down to $430,000, right? Well, think about that. 2009 was a long time ago. That was 15 years ago. We have not had a major market crash for 15 years. So Dan, are we overdue based on what happened since 1929?
We're way overdue because since 1929, we've had 17 times the stock market has gone into a bear market, which has had over 20% losses. And the average loss has been 39%, and it happens every 5 years on average. So you have to be prepared and you have to set up your plan to guard against those things happening because they've happened before, and we want to make sure it doesn't happen again to you. You're back with Dan and Jim, the Peak Financial Freedom Hour. And today, the topic of the show is it's time to prepare for retirement. And we know a lot of you are out there saying, I've already prepared. I have a 401k. I have an IRA. I have a brokerage account. I have CDs. I have rentals. I have an advisor even. Well, you're not prepared if you do not have a customized, comprehensive, written retirement income plan that looks at every single thing about your money. And that's what will allow you to see that you're going to either succeed or not succeed in retirement. And you need to know that now. So if you're planning not to succeed, we have to make sure we adjust your plan so you can succeed. If you're ready and you can succeed, then you need to have the opportunity to decide when in the heck is it that you really want to retire. Do you have to work from 62 to 67, or can you retire at 62 or 63? Let's look at something that I think, Jim, you talked about right at the end of the last segment, and that was the volatility, the potential for loss, and what that would do to people. So let's look at what has been named the lost decade in the stock market, and really how it just crushed people. The last lost decade was from 2000 to 2009. And during that time period, we went through two of those major market crashes that you're talking about. 2001 and 2, market fell about 54%. 2007, 8, 9 fell about 53%. And during that time period, it was one of the only 10-year time periods, but it's happened where it was an actual negative loss during that entire 10 years. So everyone says, well, if you leave your money in the market for 10 years, you'll always break even. It's not true. No one can say that. They're lying if they say that. And it was significant because if you hung in there and you went through 2000 and 2009, maybe cover what types of gains and losses we had during that time period, you would have ended up with over 9% loss. And that's assuming no fees and not taking in income distributions.
I can imagine taking income. So imagine you retired at 65, you went through that 10-year period, you lost 9%, you kind of wrote it out, hope it would come back. Meantime, you're taking 4 or 5% off your portfolio assets in the form of income because you need income, right? That's what you save the money for. Now you're down 50, 60, maybe 70%. Because when the market goes down, when it's down 9%, it doesn't mean it's down just 9%. It was down 53%. It was up 7, down. It's all over the board. The markets just don't level out at 9%. So when you're taking income off an asset base and the markets are dropping, it's significant, Dan. People have and they will run out of money if they're not positioned correctly.
Well, here's a good example, just based on just what you said. What if you were in this time period from 2000 to 2009 and you're retired? So let's just say it's 2000, you retire today. And then we go through a 9.1% loss in 2000, an 11.9% loss in 2001, a 22.1% loss in 2002. You say, well, that's not going to happen. Well, it happened. So we have to be prepared that it can happen. But then they say, don't worry, hang in there. The market will always recover. Well, it did. In 2003, the market went up 28%, 2004, 11%, 2005, 5%, 2006, 16%, 2007, 5%. We think we're more than ahead.
Yep.
Then in 2008, in that calendar year, the market went down 37%, total market collapsed 53%. But then in 2009, it went back up almost 27%. So we think we are far ahead. Well, if you receive those rates of return on $1 million and you just wanted to take out 50,000, your 5% number sounds reasonable. And you just paid 1% fees, which most consumers that have advisors are paying double that. At the end of the first year, you'd be down to 849,000. At the end of the second year, 689,000. How would you like to start your retirement after the third year with $480,000 left in your portfolio, less than half? And then we made the gains back. But from 2003 all the way to 2007, we had positive gains. Your portfolio, even though you took income out and made all great gains, only grew from 480,000 to 546,000. Then in 08, you got hammered with a big loss. You're down to 289. And in 2009, even after making 26%, you were exactly right with your number. You're at $300,000 of assets left. You've lost 70% of the value of your portfolio. Think about what that would then make you feel if this is you.
You know, it's like a roller coaster that you described it, right? From 2000, 2009, you had ups and downs. As a matter of fact, this last weekend, I was in Disneyland. I took my grandchildren to Disneyland. And I've been on those roller coasters. I was on them last weekend. It is scary, right? It chugs up to the top, like the market's gone up. But when it goes down, man, my stomach churned. And that's only a 3-minute ride. When you're looking at 2001 and 2 and 2007, 8, 9, that's a 3-year period. And people have to hang in there for 365 days, each one of those years, with hopes that they're not going to run out of money. And most people can't do it, Dan. They get out at the wrong time. They make financial mistakes. They do all kinds of things. They stress out. So people, folks, there's ways to solve this problem. You can eliminate this risk or at least mitigate it tremendously. But you have to use different strategies. You have to use different financial instruments, and you have to have a plan in place before you invest your money, before you get into a position where it's too late.
Well, think about it. A lot of people right now, they don't make changes because they literally, either have thought themselves or believe themselves or been told by other people that they don't have to worry, they don't have that much risk, and bad things can't come to them. Their money won't run out. They can take out a high level of income. They're going to get huge gains in the stock market. Even with losses, it'll come back. Well, you can't think of that as the way you plan for retirement. That's planning on a best case scenario. You cannot go into retirement planning on a best case scenario. You have to go into retirement planning on a worst case scenario, meaning if the worst things happen in the market, will your retirement income plan still work and guarantee you won't run out of money for as long as you live and give you more income on a monthly basis than you need to spend so that you don't have to worry about your money? And if you can do those things, now you have a plan that could potentially work.
Well, the problem is people, again, they don't understand what a plan really is. They listen to us, they're driving down the road right now, and you say to yourself, well, that makes a lot of sense, Dan and Jim, but a lot of people don't do anything about it.
They think they already have it because they get statements.
Yeah, and they don't at all. And we're not saying you have to work with our firm. What we're saying is find a firm that does what we do, meet with them, get a second opinion so that you're intelligent about your money before something happens. And people think, Dan, the markets take a long time to go down. They could go down swiftly. Take August 5th of this year, right? 6 weeks ago. The market on that Monday morning, the S&P 500 over just a few days was down 11%. The NASDAQ was down 15.9%. And the reason for that is the Japanese stock market, which is a day behind us, it was open on Sunday, our time. 2 hours before our market opened, it crashed at one point down 26%. It changed the world in a matter of minutes. Now, that market should have continued, Dan, to go down and down and down. When a major stock exchange like the Japanese stock exchange falls like that, it's very similar to the size of the S&P 500. It should have continued to go down. We should be down right now, but we're not, because what happened is the institutional traders and the hedge funds and the private equity groups that control trillions of dollars, they decided to step back in because they got out, they went to cash in order to protect their assets, but they got back in.
Well, because they bought in low.
That's right. They bought in. But that's the only reason this market came back. So if you're down 11 or 15% in one day, I mean, that happened just one day, bam, it's down. And then the market keeps on going down, which it should have, but it didn't. We're lucky. Imagine how that would feel right now if you're getting close to retirement or in retirement.
Well, that goes down to you have to plan for the worst case scenario. When we put plans together, we're going to put the plans together based on the worst case scenario so that you'll know even in the worst case scenario, everything will be fine in your life. You're back with Dan Allman and Jim Files with the Peak Financial Freedom Hour. And today we are talking about the topic of it's time to prepare for retirement. And we talked about at the beginning of the show, a lot of people think preparing for retirement is saving money and then building up this big pile of assets. So at retirement now, you can have enough money on a monthly basis to last for as long as you live. The problem is everyone gets stuck in what's called stage one, which is asset accumulation. And you became a really good saver. In fact, you found yourself to be a really good saver because you saved $1 million, $2 million, $3 million, which is a big chunk of money to put together during your working career. So you became a really good saver. And you think now because of that, you have kind of succeeded, but you're still unsure if that will get you through retirement. So the first thing you have to remember, which we talk about a lot, is you have to transition from being a saver and accumulating assets with volatility into preserving those assets against large losses and then creating income that's dependable that will replace your paychecks. Because right now, once you've succeeded, you saved $1 million, $2 million, or $3 million, or even more, the one thing that would hurt you right now, Jim, is a big loss.
Yeah.
A big loss would hurt you. And we always ask clients this question. Let's pretend like you have $2 million. And if you get a 50% gain and your portfolio goes up to 3 million, or you get a 50% loss and your portfolio goes down to 1 million, which one has more impact on your future?
Of course, the loss will be. And the loss will affect you not only financially, but it'll affect you mentally, right, and emotionally, because if you're listening right now, everything we're saying is what you thought about if you're getting close to retirement or retirement. You think about this, right? But you stay the course because you have a habit. And the habit was or has been that I'm not going to do anything. And that's been the habit, right? You've had a habit of saving for 40 years, which has been great. You've saved and saved and saved. But now you have to change your habit, which is difficult to do for people because the habit is indoctrinated. It's ingrained in your personality.
Well, for 30 years for people.
Yeah, it is. And it's really difficult for you to pick up the phone and call us and say, I want to get a second opinion, right? Because you have this habit And that habit's very, very difficult to break. But
well, and that habit wasn't bad. That was a good
No.
thing. That was a good habit while you're accumulating assets to be as aggressive as you possibly could to get the higher rate of return. So we're not saying that habit was bad. We're saying from this point forward in your life, if you're in retirement or getting ready to retire, it's going to be a very bad habit to have if you're that overly aggressive. And it really comes down to what our next topic is, and that is why people really can't prepare for retirement the same way their mom and dads did, their grandparents did, their friends did, whatever. It's good. Things have changed. Why don't we talk real quick about changing retirement ages in the U.S. specifically, and then longer life expectancy, because both of those, right, have changed it. It used to be, oh, everyone retires at 65, and then you had a lifespan of like 75, so you just had to plan for 10 years. That was pretty easy. But now if people plan to retire at 55 or 60, or 62, knowing that they're probably going to live to 85 or 90, what does that do to the whole planning protocol?
Well, it messes up everything. That's why the social security system is so messed up, right? Because this was never planned. Life expectancy has elevated to a point where people are living longer. That means they need more assets, or more importantly, more income that is safely distributed to them, so that when they do live to 85, 90, 95, my grandmother lived to 103 years of age. My aunt lived to 102. And they never thought they would, but it can and will happen to many of us, and hopefully it does. But more importantly, you better have those assets positioned so you don't lose them, and you have an income distribution for your entire life. And the beauty about that, Dan, you can get an income distribution off your assets, guaranteed to last for as long as you live, regardless of what markets do, regardless if you have money or not.
What you just talked about there covers the next 2 points I was going to just bring up to discuss, and that is the decline in pensions over the last 30 years. And then you mentioned it earlier, the challenges Social Security is going to face. Well, Social Security is considered an annuity, a guaranteed form of income. Pensions are considered an annuity, a guaranteed form of income. Well, the problem now is, I'd say of all the people that come and see us, I'd say 5%, 1 out of 20, has a pension that will cover all their wants and needs. 95%, 95 or 19 out of 20 don't. And we have to create a considerable amount of income that will be guaranteed for as long as they live, and if they're married, for their spouse. Same thing with Social Security. Right now, it's already projected Social Security is going to drop 20 to 25% once we hit the bankruptcy side, which is in the 2030s they're talking about. So right now, if you think of 19 out of 20 people don't have pensions, and then the people that have Social Security are going to reduce that. They won't lose it, but they'll reduce it. We have to now, and you have to, as consumers, as retirees, find a way to create a guaranteed lifetime income for you and your spouse that'll last forever, that will never run out, you can depend on. Because if you don't have the income, you're not going to have the lifestyle. University of Chicago, I think, has done like 10 studies over the last decade now based on who are the happiest, healthiest, and longest lived retirees. It's those people that have the most fixed, guaranteed lifetime income, whether it's from pension, Social Security, or annuities. Those are the ones that live longest, are happiest, and can live the life that they want to. So we have to focus on that. How about these last two? Why you can't prepare the same way? With market volatility that we're going through today versus 30 years ago, in the lower interest rate environment now that we're finding ourselves in because of the Feds reducing rates, what does that do to make it hard to prepare for retirement?
It's going to be very, very hard, because right now interest rates are going down. They're going to go down precipitously over the next year and a half or 2 years if inflation continues to be under control. And that 4 or 5 or 5.5% you got in CDs just going to vanish very quickly. So what you thought you could take out in the form of income off your fixed income is going to be reduced down to 3, 2, and probably down to 1 if this economy it proceeds at the pace it's doing with inflation going down. So there are financial instruments right now down today that are paying 5, 6, 7% distribution rate guaranteed for life.
Well, even higher than that. I just did a plan for a client. They're 62. They're going to defer their payments to 67, use off some other assets, and current rates gets them a 10.3% guaranteed income payout. Currently, that's going to go down with interest rates, but 10.3% guaranteed for life, that would be like saying I locked in a CD for 10.3% as far as the impact on your finances with how much income's coming in.
Yeah, and the beauty about that is that anybody can get them, but there's no medical required. The products today are the best they've been in probably 2 decades, maybe 3 decades. And you can lock in those very high distribution rates. They are going to go down. They're going to follow interest rates down. But once you lock it, unlike a CD you only can lock for like a year, maybe a year and a half or 2 years. These you can lock for the rest of your life.
You're back with Dan and Jim, the Peak Financial Freedom Hour. And today we are talking about how it is time for you to prepare for retirement. And we know a lot of you have been really, really good savers, and that's why they listen. That's why you might listen to the show. It's like, what do I do now? Because everyone sits in front of us as a new potential client, and they've done a great job saving money because you can't get in front of us unless you have saved money for retirement, because that means you need planning. Well, the ones that are sitting in front of us now, they know they've done a good job in saving, but they have no clue how to use all those savings to now create income that's going to replace their paychecks once they retire, because that's their biggest fear, knowing that 19 out of 20 people we get in front of, they don't have big pensions. So this topic right now for this section of the show is going to be time to prepare for retirement, but how can you avoid the number one fear of retirees? And that's to make sure your money does not run out, because the number one fear of retirees for all of us is that our income is going to run out before we do. And I think a lot of us think that means our assets will run out. It doesn't matter as much if our assets run out. It matters, Jim, if our income runs out, because income always equals lifestyle. Income equals your trips. Income equals you being able to take your kids back down and grandkids back down to Disneyland. Income equals going to Europe. Income equals buying that new car. Income equals making sure you can pay for your medical costs, all those things.
Yeah, I mean, and I think a lot of people don't really understand or really thought through what the definition of income in retirement is, because you only get two choices. It's very simple. You can generate income that is not guaranteed, right? It's income coming off your portfolio. It's subject to what the market does with your assets. So when the market goes up, you feel more comfortable about taking income up, but you're still concerned and worried about what if the market goes down. And when the market goes down, you're taking income off your portfolio. You're really, really scared because what if the market keeps on going down? So that's one way of getting income. That's income off your portfolio, and you're constantly looking at the stock market, hoping that it doesn't drop. The other way of getting income is guaranteed income, and guaranteed income comes from pensions, for example, right? You got a guaranteed income from your pension that you worked for. Maybe you work for the federal government, maybe you're a teacher, maybe you're a fireman, and you've got a guaranteed pension income stream. Guaranteed income is Social Security. It's another type of annuity, right? It's backed by the federal government. They're going to guarantee you an X amount of money every year. There's also a way to make a private pension if you don't have a government pension or an employer pension. And you can actually take some of your assets that are in the stock market or in the bank, and you can make your own private pension. And that pension will work just like a pension coming from the government, in that it's guaranteed for your entire life. It's backed by a large insurance company, and it will give you a lifetime income stream. Guaranteed or not guaranteed, the consumer gets to pick that, Dan.
Well, and I think that's the key, because we know, we've dealt with thousands and thousands of people. The only way to eliminate their fear of running out of money is to create income that's guaranteed not to run out. And you think about it, it's pretty simple. It's black and white. Wash away any of your thoughts as far as what type of asset we use or what company it's with. Just think about it. The only way to get rid of your fear of running out of money is to make sure your income is guaranteed forever. Just like right now, if you have $2 million of assets, would you rather have the $2 million of assets, or would you rather have $150,000 of guaranteed pension income from the state for the rest of your life? And 90% of people, it's shown, will pick the pension because they don't want to have to worry about their income running out. So let's look at then what the steps we go through to build a plan that will help retirees get rid of the fear of running out of money. Step 0 is actually not even step 1. We call it step 0. That's your budget. We have to complete a budget, because that will tell us exactly how much money on a monthly basis you need coming in, so that you don't have to worry about your money. But you have to take it a step further. Not only do we do a comprehensive budget, let's say your budget comes in at $9,000. You cannot create a plan that's just going to provide you $9,000 a month of income, because each month your budget changes. We want to create a plan that has a minimum $12,000 a month of net income, because now we have a $3,000 buffer or a $3,000 net excess monthly cash flow after taxes that they can save, they can spend, they can invest, they can gift it. And then how does that make people feel once that type of plan is created versus just trying to meet their budget?
I mean, they're shocked when they can see that they can really produce that level of income off their asset base, because what they're used to looking at is, if I have a portfolio in the stock market, the bond market, I can take off. The safe withdrawal rate right now is 3%. So I can take off 3%. And even by taking off 3%, you're not guaranteed you will not run out of money. You still have a 10% probability that you're going to go broke. But when you introduce different financial instruments, we can take that 3% maybe to 6, 7, 8, 9, and even 10%, all of a sudden you can get significantly more cash flow off those same assets in the form of income that you could off a managed portfolio, Dan.
And without the fear that they had before that if they took too much income, their income would run out at a later point in life. What if you can take a high level of income now when you're young and do all the things you want to do right now when you're able to do them, and still be guaranteed that you have that exact same amount of money coming in every month for as long as you live, and if you're married, for as long as your spouse lives, even if one of you lives to 103, 105, etc., the income's guaranteed to be paid regardless of stock market crashes, regardless of what's going to happen with the growth of the asset, and regardless of how long you live. It doesn't matter, the income's going to be paid. And when you look at, then again, getting rid of the fear of running out of money, the only way you're going to get rid of your fear is to create a significant amount of income that's guaranteed to last for as long as you both live, without the fear of that income stream ever terminating.
For more information about Peak Financial Freedom Group or to schedule a consultation, just go to our website, peakfin.com. That's peakfin.com. And thanks for watching.